Warren Buffett and Berkshire Hathaway, the patient capitalist. Omaha, Nebraska, early May.
If everyone will please take their seats.
This is not a basketball game. It is not a rock concert. It is the annual meeting of Berkshire Hathaway. Tens of thousands of people have flown to the middle of the United States to sit in a giant arena and watch two elderly men on a stage answer questions for hours. No pyrotechnics, no product launches. Just talk. One of those men is Warren Buffett. He's about to spend the day explaining, in simple, homey language, how he has turned a failing textile mill into one of the largest and most admired conglomerates on earth. The magic trick he keeps repeating is almost offensively simple. Buy good business, let them run, don't panic. Warren Buffett is born in Omaha in 1930, right into the teeth of the Great Depression. His father runs a small brokerage. Sometimes the atmosphere at home is tense. Clients panic, markets fall, jobs disappear. Warren sees early that money can make adults scared and strange. He also sees numbers as something comforting. As a child, he does not just count. He keeps ledgers. He sells chewing gum and Coca-Cola door to door. He runs paper routes, memorizing streets and customer names, tracking his earnings in notebooks. He buys a pinball machine, parks it in a barbershop, then several more, like a tiny franchisor before he can legally drive. The pattern is clear early. He likes businesses where you can add up the coins at the end of the day and know where you stand. As a teenager, Warren finds a book that changes everything, The Intelligent Investor by Benjamin Graham. Graham is a professor and a money manager in New York. His idea is that stocks are not lottery tickets. They are partial ownership in real businesses. Sometimes the market underprices them. Sometimes it overprices them. If you can learn to tell the difference, you can treat the market not as an oracle, but as a very emotional partner who occasionally offers you bargains. Warren is hooked. He memorizes the book, writes to Graham, and eventually goes to study under him at Columbia University. This is his version of meeting a rock star. Graham's style is cautious, almost pessimistic. He looks for companies trading below the value of their assets. Cigar butts, as he calls them. Ugly, discarded business with one or two good puffs left. Warren takes that idea and brings it back to Omaha. In the 1950s, after a short stint working in Graham's firm, Warren moves home and starts his own investment partnerships. They are small, almost quaint by modern standards. A few local doctors, relatives, friends. He puts in his own money, takes a cut of profits above a certain hurdle, and sends out letters explaining what he's doing in plain English. He does not tell them which stocks he's buying. He tells them how he thinks. Look for value. Avoid speculation. Be fearful when others are greedy, and greedy when others are fearful. For years, he quietly crushes the market. He buys into tiny companies hardly anyone has heard of, holds until they re-rate or are bought out, and then rolls the profits into new ideas. No CNBC, no Twitter. Just letters, ledgers, and the man in Omaha reading annual reports. Then comes the deal he later calls his worst. He buys a struggling New England textile manufacturer called Berkshire Hathaway. It is cheap, too cheap, he thinks. Classic Graham fodder. He starts buying shares. There is a drama with management. He ends up taking control of the whole company. The problem is, the underlying business is terrible. cheap for a reason. Textiles in America are under pressure from cheaper overseas competition. The economics are brutal. Capital goes in. Margins are thin. Returns miserable. But instead of simply liquidating it and moving on, Warren uses Berkshire as a shell, a holding company. He gradually winds down the textile operations and starts using Berkshire's legal structure and access to capital to buy other businesses. What began as a mistake becomes a vehicle. The true engine of Berkshire's rise is not a textile mill. It is insurance. In the 1960s and 70s, Buffett buys insurance companies, starting with National Indemnity and later Geico, the auto insurer with the little gecko in its ads. Insurance has a special property. Customers pay premiums now. Claims are paid later. In between, the insurer holds a pool of money called float. If you run an insurer well, pricing policies correctly, controlling claims, you can invest that float. The returns on those investments accrue to the company's owners, not to the policyholders. Warren realizes that if he can run a collection of insurance operations prudently, he will have a growing river of low-cost capital to invest elsewhere. Other people's money, entrusted to him, that he can put to work in stocks and whole businesses, while still being able to pay claims as they come due. It is leverage, but of a very particular, disciplined kind. Around this time, another figure steps onto the stage of Buffett's life. Charlie Munger. Munger is a lawyer by training, a fellow Omahan with a sharper tongue and a slightly different view of investing. He tells Warren bluntly, "Hunting forever for cigar butts is a hard way to live. The real money is in owning a smaller number of great businesses for a very long time." This nudges Buffett's philosophy. He still loves value, but he starts to define value not just as cheap relative to assets, but as quality at a fair price. Businesses with moats, durable competitive advantages. Brands people love. Networks that are hard to replicate. Low-cost producers that competitors cannot undercut. He buys See's Candies, a West Coast chocolate company customers adore. The economics are fantastic. People pay more than the cost of ingredients for the brand and experience. The company does not need much capital to grow. He buys more of Geico, eventually the whole thing. He buys stakes in Coca-Cola, in newspapers, in precision manufacturing companies. The pattern is the same. Strong franchises, honest management, reasonable or better prices. Then, wait. By now, Berkshire Hathaway is not really a company in the traditional sense. It is a collection of dozens of companies. Railroads, utilities, insurance, retail, manufacturing, service businesses. Many of them are wholly owned, with their own management, brands and cultures. Berkshire's headquarters in Omaha has a famously tiny staff for a company of its size. There is no central HR department telling a carpet company in Georgia and an insurance firm in Maryland how to run their day-to-day. Buffett's model is delegated capitalism. He buys businesses with leaders he trusts, then leaves them alone. In return, he expects honest reporting, sensible capital allocation, and a phone call when something big is going wrong. Profits in the form of dividends or retained earnings roll up to Berkshire, where Warren and Charlie decide where to deploy them next. Over time, this creates a kind of internal market. Cash from a Nebraska furniture store might end up helping buy a railroad or a stake in Apple. One way to understand Berkshire is to imagine a snowball rolling down a hill. At first, it is small. Every new bit of snow is noticeable. But as it rolls, it picks up more and more, and its own weight helps it compress and gather even faster. Returns on capital compound. Profits are reinvested into things that make more profit. The numbers become surreal when you graph them. A dollar invested with Buffett early in his partnership days explodes, over decades, into sums that feel like typos. From the outside, this looks like genius. From the inside, Buffett insists, it is just arithmetic plus temperament. The arithmetic of compounding. The temperament to stick with it. Buffett's greatest talent may not be picking stocks. It may be ignoring everyone else. He famously does not watch live market ticks all day. He spends hours reading annual reports, newspapers, trade journals. He does not place bets on quarterly GDP or next month inflation print. When asked about the Fed, he often shrugs off the question. He acknowledges that interest rates matter, that central bank actions affect discount rates and valuations, but he refuses to build his world around predicting them. He buys businesses he believes will do well under a range of macro conditions. He does not try to guess the next rate move. He tries to guess whether people will still be drinking Coca-Cola or riding trains or buying insurance in 20 years. His letters to Berkshire shareholders are models of clarity. He explains complex ideas with analogies about hamburgers, farms, and bridge. He tells people that if they are not willing to watch their holdings fall 50% in a crash without panicking, they probably should not own stocks at all. He tells them that his favorite holding period is forever. Ironically, this patience and reserve make him uniquely powerful in crisis. In 2008, when the financial system is seizing up and trust evaporates, Berkshire has something everyone else lacks: cash. While others scramble to survive, Buffett can pick up the phone and offer lifelines. He invests in companies like Goldman Sachs and General Electric through preferred shares and warrants that pay Berkshire rich dividends and give it cheap options to buy ordinary stock later. To the public, he frames it as a bet on America, a statement of faith that the system will endure. To Berkshire shareholders, it is also a fantastic deal. Steep terms, negotiated at a moment when few others have both the money and the credibility to step in. He's not a charity, he's a patient predator. But in being willing to move in when others cannot, he stabilizes as well as profits. It is easy to turn Warren Buffett into a cartoon, the folksy billionaire in khakis and a tie, eating McDonald's, drinking cherry soda, rattling off zingers about the market. Behind the myths, there is a more nuanced person. He is intensely competitive, devouring information to maintain his edge. He is self-depreciating about his misses, like avoiding most fast-growing tech for decades, but also stubborn about his circle of competence. If he doesn't understand it, he passes. He has a complicated personal life, marked by a long, unconventional marriage, close friendships, and a late public turn towards philanthropy, pledging to give away most of his wealth. He has strong opinions about leverage, derivatives, corporate governance, and the dangers of short-termism. He has also, at times, benefited from structures and tax regimes that critics argue favor people like him disproportionately. He's not a saint. He's also not a villain. He's a human being who has spent more than 70 years trying to answer one question: how do you allocate capital wisely over time? The reason tens of thousands of people flock to Omaha each year is not just to see a celebrity. It is to participate in a kind of financial pilgrimage. They come to hear a different story about money than the one blasting from most screens. A story where you do not have to trade constantly, or outguess central banks, or chase the latest meme stock. A story where you can buy pieces of real businesses, hold them, and let compounding quietly do the heavy lifting. Berkshire Hathaway, in this sense, is not just a company. It is a counter-argument. A bet in a world obsessed with speed, patience itself can be an edge. But there is another world out there that sometimes feels like the mirror image of Omaha. A world of glass offices on the West Coast, not brick buildings in Nebraska. A world where the goal is not to buy established businesses with steady cash flows, but to fund risky ideas before anyone knows if they will work. Where do you not demand profits today or even next year because you're betting on networks and software and scale that could, if they hit, redraw entire industries? Instead of cherry cokes and railroads, the props are pitch decks and hoodies. Instead of dividends, there are cap tables. The people in that world are not patient in the Berkshire sense. They are impatient on purpose. They want to move fast, break things, pivot, chase product market fit. And yet, under the surface, they are wrestling with the same core problem as Warren Buffett. How do you deploy capital into an uncertain future? In Omaha, the answer is carefully, slowly, with a long memory. In Silicon Valley, on a stretch of road lined with understated low-rise offices, the answer has been very differently. Spread bets across many founders, accept that most will fail, and hope a few will be so big they pay for everything. That road has a name: Sand Hill Road. Next time, we will leave the annual meeting and fly west to the foothills above Palo Alto, where partnerships with names like Sequoia and Kleiner Perkins, Benchmark, and Andreessen Horowitz quietly decide which technologies and teams get to try and maybe fail on a massive scale. If Warren Buffett and Berkshire Hathaway built a template to patient capital, Sand Hill Road will show us the chapel of risk capital. The place where the money behind your favorite apps, platforms, and unicorns first changed hands long before an IPO ever hit a ticker.